Okay, everyone, I wanted to take another few minutes and talk about the qualified business income deduction. I know some people were questioning, they still didn't understand it. So I want to make sure we are all on the same page when it comes to that. So I'm on page 628 of your book. Now the deduction, make sure we make that a little bit bigger. The deduction for qualified business income, or what we call QBI for short. In accounting, we have tons of acronyms, is something very new, and it came out in 2018. And if you think back to our tax formula, we took gross income minus deductions for AGI. That gave us AGI. We then deducted the greater of standard deduction or itemized deductions. And then we also said you may, if you qualify, be able to deduct part of your qualified business income. So that's what this is. That's what we're talking about here, deduction for QBI. And once you deducted that amount, if you're eligible, you get to taxable income. So that's our focus here. Not everybody's eligible for it, but that's what we want to take a few minutes and make sure you understand who is and how to calculate it. So first of all, people who are allowed to calculate and deduct this on this tax return are basically those in small businesses that report their profits on their return. So who? Sole proprietors, partners in partnerships, general partnerships, and owners, shareholders in S corporations. Because these are the individuals who take the profits of their business and report them on their tax return and are able to take or pay income tax on their personal tax return. What can they deduct? The lesser of two calculations, 20% of their QBI. So we need to make sure we understand what QBI is from a qualified trade or business. So I'm just doing some acronyms there. Plus 20%, whoops, of their qualified real estate investment trust dividends. So if the taxpayer is involved in a qualified real estate trust and they receive dividends from it, 20% of those can be deducted. And a qualified publicly traded partnership income. So that's 20% of that as well. So 20%, and this is our main focus, of qualified business income from a qualified trader business. They could add to that 20% of dividends they receive in a qualified real estate investment trust. And they could also add to that 20% of their income related to a qualified publicly traded partnership. Compare that computation. So it's the lesser of 1 or 2. Now 2 is 20% of the excess of taxable income over the taxpayer's net capital gains. Okay, so it's the lesser of the 20% of taxable income minus net capital gains, including qualified dividends. Okay, so it's gone a little bit beyond what you would think qualified business income is. Okay, So we want to make sure we understand how to calculate these different items. They go on to talk about a qualified business, what it is. So you could read through that, obviously. Some things are excluded, like architects and engineers. They had the lobby to get them out of this, okay? For limitations. So take a look at the last paragraph on page 629. For any year in which a taxpayer's taxable income is less than 163,300, you see the married filing joint, the exclusion for specified service, trades, or business will not apply. So we do have a limitation up above for specified service, trade, or business, and it's based on taxable income. Let's go right into the examples. You could read, right? As described in examples 5.7 and 5.10, Courtney is an architect consulting service and generates rental income from a condo she owns. Will her income from the architect service and condo rental be considered qualified business income? Yes, for the architect service and possibly for the condo rental. Architect services are not a specified service or trade business. Thus, her income from it would be qualified trade or business income. Income from the condo rental would be considered QBI if the activity is deemed a trade or business based on facts and circumstances. If not, it would not be. So what they're referring to there is back to page 629. If your taxable income is above a certain amount, it's going to be considered a specified service, trade, or business. Now you're going to be limited to your amount of QBI deduction. But since she's an architect, she doesn't have any income limitations. Architects and engineers got themselves in as not being limited to a QBI deduction. Assume in our next exam, what if, on page 630, Courtney decides to establish a sole proprietorship to perform investment advising services. She reports $250,000 of taxable income before her deduction. Will her income from the investment advisory services be considered QBI? No. Here's where this income limitation comes in. No investment advisory services fall within the definition of a specified trade or business because her taxable income exceeds $213,300, which her QBI starts phasing out at $163,300. Once, and it phases out over a $50,000 range. That's what's explained on page 629. So once a single person's taxable income is at $213,300, there's no QBI allowed. So they're trying to weed out people who they are considered in higher income. Assume instead in the next, she establishes her sole proprietorship to perform investing advisory services. This year, Courtney reports $100,000 of taxable income before the deduction. Will that $100,000 be eligible? Yes, because her taxable income is below $163,300. The exclusion for specified services will not apply, and this will be deemed a QBI, a qualified trade or business. So you see these different scenarios and how this applies. Assume in our last, she establishes her sole proprietorship to perform investment advisory, and she reports $193,300 of taxable income before the deduction for QBI. Will her income from those services be considered QBI? Some of it. So if she has $193,300 before this deduction, 60% of her income would be considered QBI because the phase out of 100% of it would start occurring at I'm sorry, at 163,300. So take her taxable income at this point minus where the phase out begins, 163,300, divided by the phase out range. So the remaining 40% of her investment advising income would be considered QBI. So what you're calculating there is the portion that is not considered QBI. So we need to look at the person's taxable income before the calculation of this deduction. And we have to also look at so if their taxable income is below the limit, it doesn't matter. Their income qualifies, they have a QBI. If it's above, we may need to phase out how much of the profit is allowed as to be used in calculating the deduction. However, if you're in certain businesses, like an architect or an engineer, there is no limitation based on taxable income. So that's what they're talking about there to help us determine how much to even use in this first calculation. Now, there's further limitation. And these are on page 631. Once you determine the qualified business income deduction, the deduction cannot exceed the greater of two calculations. One, 50% of the wages paid in the trade or business, or, and here it gets a little crazy, it's taxes, the sum of 25% of the wages with respect to the trade or business, so the wages, plus (2.5% of unadjusted basis of qualified property in the business. So your deduction after the first calculation cannot exceed either one, the greater of these two amounts. So I know this is getting crazy, but Congress created it, so we got to deal with it. Take a look on page 6-31. So here we have Courtney reports taxable income this year of $149,622 before the deduction for qualified business income, and she has no capital gains and $700 of qualified dividends included in her taxable income. Her architectural consulting services generated $17,759 of qualified business income, $18,000 of profit, less her $241 deduction for self-employment taxes. And she paid no wages in this business. Let's assume that Courtney's condo rental is considered a trade or business, which generates $5,000 of qualified business income. What is her qualified business deduction? First of all, because her taxable income before the deduction is less than that 163,300, this wage limitation that we just determined does not apply. So it's when taxable income is above the statutory amounts, in this case, the 163,300 for a single individual. Also, well, then I should say this limitation applies. So Courtney is not limited by the taxable income limitation because 20% of her qualified business income which would be the 17,759 times 20%. So her QBI, go back to your reading, is her profits less the part of self-employment tax she can deduct on her tax return, 1/2 of it, plus her rental property income, I believe that was the $5,000 times 20%. So those two added together is less than 20% of her taxable income in excess of her qualified dividends and before this deduction. So remember the second part of this. So here's the first part, 20% of QBI and 20% of her real estate rental. Then take 20% of taxable income minus the capital gains minus qualified dividends. Okay, 20% of that. The lesser of those two amounts is the amount of the deduction. So the 4552 is the amount you can deduct. Let's take it a step further. Assume Courtney reports now taxable income of $300,000. She has no qualified dividends or capital gains, and her architectural consulting firm generates $75,000 of qualified business income. She has no qualified property and pays $20,000 of wages. What is her deduction? Well, it's $10,000 before any limitation. Let's take a look. Her qualified, 20% of her qualified business income is $15,000. 75,000 times 20%. Now, even though she's an architectural firm, her taxable income is above that limit. So now the next phase, the next group of tests comes into play. So we're going to say, well, what's 50% of the wages paid? They give us that in the problem, 20,000 times 50%, 10,000. So that's your answer for part one. Add to that, or compare that to, 25% of the wages paid. So 25% of 20,000, 5,000, plus 2.5% of the unadjusted basis of qualified property. Well, she has none. And they would give you that. Okay, that's a little bit beyond our scope. That's getting really crazy with determining what's qualified property. So you would be given that. Well, she has none. So the second part of this problem, part two, is $5,000. So take the greater of those two, 10,000. Her result from this first calculation was 15,000. Well, since her taxable income, even though her QBI is not limited by her taxable income, so this calculation up here was not limited because of the type of firm she has, it still may be limited because her taxable income is above that threshold. And it's limited to these calculations below. So since her calculations down here are 10,000, her calculation above is 15,000, she's only allowed to take 10,000. That's how these calculations come into play and affect that deduction for QBI. Why couldn't they make it easier? Because you're dealing with the government, right? So hopefully that shines more light on the QBI deduction and the intricacies of how you have to take this step by step. First, determine what is my QBI? How much can I use? Do I have a limitation because of my taxable income before I even calculate it? And if I do, what is the amount? Can I even take the deduction for QBI? Like we saw Courtney, when she was in a certain type of business, wasn't even eligible. Then once we calculate that, C is my taxable income. Even if I'm eligible to use all of my income as QBI to do my calculation in the first step, do I have a further limitation though, because my taxable income is above that statutory amount? And if it is, I have to do the second calculation. And then it will be the lesser of those two. Okay, so if you have any other questions on it, just let me know.